In just a few days, three of the most powerful banks on the planet report earnings on the exact same morning. Goldman Sachs has already managed more than $1 trillion in mergers and acquisitions this year alone, a record pace for any investment bank in a single 6-month stretch. JPMorgan is sitting on the largest balance sheet of any bank in America, and options traders are already betting on some of the biggest single-day price swings these stocks have seen all year.
So, are these bank stocks actually about to explode higher? Or is Wall Street setting up for a disappointment after pricing in near-perfect results? Let's find out. If you're new to the channel, subscribe now and turn on the notification bell so you never miss our latest stock market updates, investing strategies, financial education, and wealth-building content. Quick note before we dive in. As of recording this explainer, none of these three banks have recorded their second quarter results yet. So everything financial in this breakdown reflects the most recently confirmed numbers and Wall Street's expectations heading into results, not the actual outcome. I'll be clear throughout about what's confirmed and what's still a forecast. If timely earnings previews like this help you get ahead of the market, subscribe so you don't miss the next one. Like this explainer if bank stock breakdowns are useful to you, and comment below which company's earnings you want us to preview next. Let's start with the date that matters. JPMorgan, Goldman Sachs, Bank of America, Wells Fargo, and Citigroup are all scheduled to report second quarter results on Tuesday, July 14th, before the market opens, with Morgan Stanley following closely behind. This kind of simultaneous reporting from the biggest banks in the country creates a genuinely significant market event, especially since it lands on the exact same morning as a key inflation report, meaning investors could be digesting bank earnings and fresh economic data at the very same time. Options markets are already pricing in unusually large potential price swings, with implied one-day moves of roughly 4.5% for Bank of America, 4.4% for JPMorgan, and a striking 6.0% for Goldman Sachs, well above Goldman's typical post-earnings move in recent quarters. When options traders price in swings that large before a single number has even been reported, that tells you expectations are running hot. So why are expectations running this hot? Let's break down each of these three companies and understand exactly what's driving the excitement. Number 1, JPMorgan Chase & Co.
Let's start with JPMorgan, the largest bank in America by both assets and market capitalization, sitting on a staggering $4.9 trillion balance sheet, with operations touching consumer banking, investment banking, and asset management all at once. In its first quarter this year, JPMorgan reported net income of $16.5 billion and earnings per share of $5.94, beating estimates by over 8%, with revenue reaching $50.5 billion, up 10% year over year. Investment banking fees specifically jumped 28%, fueled by a wave of merger activity and debt issuance.
Heading into this upcoming report, Wall Street expects revenue of roughly $48.7 billion, an 8.5% increase from a year earlier, with management previously guiding for investment banking fees to rise 10% or more again this quarter. Notably, JPMorgan has also announced a massive $50 billion share buyback authorization alongside a proposed 10% dividend increase. Both of these are incredibly strong signals of a company confident in its own capital position heading into an uncertain rate environment.
Number 2, Goldman Sachs. Now let's talk about Goldman Sachs, which enters this earnings report with perhaps the highest bar to clear of any bank on this list. In the first quarter, Goldman delivered earnings per share of $17.55, crushing consensus estimates by over 7%, driven by exceptionally strong trading revenue and a robust merger advisory pipeline. And here's the number that really captures how strong Goldman's deal-making business has been this year. As of mid-June, Goldman had already managed more than $1 trillion in announced mergers and acquisitions for the year. That is a record pace for any investment bank over a 6-month period, according to Goldman's own citation of DealLogic data. Wall Street currently expects Goldman's upcoming quarter to land somewhere in the range of $14 to $14.5 in earnings per share, which would represent roughly 32 to 33% growth compared to the same quarter last year. In fact, one analyst note framed this shift directly, describing trading as having evolved into what he called a best execution platform business, where volatility itself, not just market direction, is now a key driver of activity and revenue. And then there's Morgan Stanley. This is a firm that has transformed itself over the past decade from a trading-focused institution into a much more diversified business, with wealth management, boosted significantly by its earlier acquisitions of E*TRADE and Eaton Vance, now generating a steady, recurring share of total revenue. Morgan Stanley has beaten earnings estimates in each of its last 4 quarters, and Wall Street currently expects earnings per share of roughly $2.73 to $2.92 for the upcoming quarter. That represents growth of 28 to 37% compared to a year earlier, with revenue expected between $19.3 and $19.6 billion.
One prominent analyst has specifically called out Goldman Sachs and Morgan Stanley as the two banks most likely to outperform when this earnings season plays out. So, let's talk about the bigger forces driving all three of these stocks at once, because understanding the underlying trend matters more than any single quarter's numbers. The first major tailwind is the capital markets recovery. After a slower stretch for mergers, acquisitions, and public offerings in recent years, deal activity has clearly picked back up in 2026. We are seeing strong initial public offering activity and large-scale equity issuances happening across the market this year. When companies feel confident enough to go public or raise large amounts of capital, that activity flows directly through the advisory and underwriting arms of banks like Goldman Sachs and Morgan Stanley. And JPMorgan's leadership position in the space means it captures a meaningful share of that fee income as well. The second tailwind is trading revenue. Markets have been genuinely volatile this year, and for banks with large trading operations, volatility itself often translates directly into higher revenue, since more active markets mean more client trading activity flowing through these firms' platforms. Goldman Sachs in particular has leaned into this dynamic, and analysts specifically expect the firm's trading and advisory businesses to combine for what could be the second best quarterly revenue result in the company's history, trailing only the record-setting first quarter of this year. The third tailwind, specific to Morgan Stanley, is the continued strength of wealth management. This is a business that generates steady, recurring fee revenue regardless of whether markets are calm or turbulent, giving Morgan Stanley a layer of earnings stability that pure trading-focused firms just don't have to the same degree. Now, let's talk honestly about the risks, because a sector this hot heading into earnings always carries real dangers worth understanding.
The most important risk across all three banks is net interest margin, meaning the spread between what a bank earns on loans and investments versus what it pays out on deposits. With the Federal Reserve's rate path still genuinely uncertain, this single metric could end up mattering more to these stocks than the headline earnings beat itself. A bank can beat earnings estimates while still disappointing investors if its margin outlook softens. The second risk is credit quality. Bank management teams have generally described the American consumer as healthy, but investors will be watching closely for any signs of stress in credit card delinquencies or loan loss provisions. Any meaningful deterioration here could raise broader questions about the health of the broader economy, not just these individual banks. The third risk is simply the bar that's already been set. When analysts are already expecting Goldman's upcoming quarter to be the second best in company history, and options markets are already pricing in a 6% potential swing, that tells you a huge amount of optimism is already baked into these stock prices before a single number has been announced. As we've seen with other companies this earnings season, a merely good result rather than a spectacular one can sometimes disappoint a market that's gotten used to significant beats. This occasionally triggers a sell the news reaction, even when the underlying business performed well.
Let's talk valuation, because despite the excitement, these stocks aren't universally expensive. JPMorgan currently trades at a price-to-earnings ratio of roughly 16 times. That is a relatively modest multiple for a company delivering double-digit revenue growth and record capital return plans, recently trading near its all-time high closing price. Goldman Sachs trades at a price-to-book ratio of roughly 2.3 times. While that is elevated relative to its own history, it's arguably reasonable given its current return on tangible common equity is running solidly above its long-term targets. Analyst price targets vary across the group, with JPMorgan's average sitting around $354, implying modest upside from recent levels. Meanwhile, some analysts have set considerably more bullish targets on Morgan Stanley specifically, citing continued strength in its wealth management business.
So where does that leave us heading into Tuesday? All three of these banks appear to be walking into this earnings report with real momentum, record or near-record deal activity, strong trading revenue, and in Morgan Stanley's case, an increasingly stable wealth management engine underneath it all. But momentum heading into an earnings report and an actual explosive stock reaction are two very different things, especially when expectations are already running this high and options markets are already pricing in significant volatility. For JPMorgan, the most reasonably valued of the three heading into this report, a buy remains reasonable for investors comfortable with modest, steady upside tied to its capital return program. For Goldman Sachs, the stock with the most to prove, given how high the bar has been set, this is closer to a hold heading into Tuesday. A simply strong quarter may not be enough to move a stock that is already pricing in a historically great one. For Morgan Stanley, with analysts specifically flagging it as likely to outperform and its wealth management business providing a steadier earnings foundation, this sits closest to a buy for investors willing to accept the added volatility of earning week.
So let's bring this all together.
These three bank stocks are walking into one of the most closely watched earnings weeks of the year, backed by genuinely strong underlying trends in deal-making, trading, and wealth management. But great underlying business momentum and an explosive stock reaction aren't automatically the same thing, especially when the market has already priced in historically strong results before a single number has been reported. Remember, great investing isn't about chasing hype, it's about making informed decisions.
This explainer is for educational purposes only and is not financial advice. Investing involves risk, including the potential loss of principal, and you should always do your own research or speak with a licensed financial advisor before making any investment decisions. If this preview helped you get ready for bank earnings week, hit subscribe so you don't miss our follow-up breakdown once the actual results are out. Like this explainer if timely previews like this are useful to you, and comment below which stock's earnings you want us to preview next. Thanks for watching, and we'll see you in the next one. If you found this explainer valuable, please like, share it with friends and family, and don't forget to subscribe and turn on the notification bell for more stock market analysis, investing tips, business insights, and financial education. Thank you for watching, and we'll see you in the next one.